Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly create the financial statements, close out the accounts, and perform the current ratio. So if you're unfamiliar to all of those things, don't fret gang, I dropped the link to get you up to speed in no time. So with that being said, let's get it. So it tells us that the adjusted trial balance of Boston irrigation system at December 31st is as follows. Let's check out this trial balance. We have a beautiful trial balance. All right. And then it says prepare the company's income statement for the year ended December 31st. All right. And the requirements say to prepare the income statement, statement of retained earnings, the classified balance sheet. They want us to close out accounts. And then they want us to perform the current ratio. This is a lot, gang.
This is huge, bro.
So let's get to it. So basically, we're going to make all three of the financial statements based upon the trial balance, close out the accounts, then do the current ratio. So we're going to use this adjusted trial balance to determine which accounts belong on which financial statements. So in a quick recap, we understand that the income statement determines income for a period, which is going to consist of revenues and expenses. The statement for retained earnings shows the effect of retained earnings, which deals with our retained earnings accounts, dividends, and any net income or losses that are transferred from the income statement. And lastly, the balance sheet is simply the accounting equation, gang. And we know the accounting equation to be assets equals liabilities plus stockholders' equity. So let's go through these accounts and see who goes where. But you know what, gang? Cool thing about the adjusted trial balance is that it's a particular order in which the accounts are actually delivered. The proper trial balance order must be the accounting equation, followed by the accounts that affect equity. And so we know the very first part of the accounting equation starts with assets. However, we still must determine which assets are considered current versus non-current for our classified balance sheet. So in terms of assets, we know that cash, accounts receivable, office supplies, and prepaid insurance are all considered current assets. Why? Because we expect to convert them in cash less than a year. So in terms of long-term assets, we know that both the building and the equipment, do not forget accumulated depreciation contra accounts related to those as well, will all be reported as long-term assets. Moving on to our liabilities, we have to break them down based upon current liabilities and non-current. And so our accounts payable, interest payable, salaries payable, and unearned revenue are all considered current liabilities. Why? Because those current liabilities are expected to be paid off within a year or operating cycle. In terms of our long-term liabilities, we're going to consider the notes payable to be long-term. And the cool thing about it, gang, they already gave us a tip within the title, long-term. Moving on to our stockholders' equity section of the accounting equation, we understand that both common stock and retained earnings must be reported. Now remember, gang, by the time we report that retained earnings balance on the balance sheet, it will be fully adjusted to its new year-end amount. So we don't have to report dividends or net income or any of those other revenue expense accounts because it's already embedded into our retained earnings. So that's it for our balance sheet, which brings me to the dividend account. The dividend account will be reported only on a statement of retained earnings. Remember, gang, the statement of retained earnings is going to show the changes or the effects of retained earnings in the period. That's the second particular financial statement that must be reported after the income statement. We know that all our service revenue accounts and expense accounts will be reported on the income statement, gang, because that's going to determine how much income or loss was generated for the period. So now that we know what goes where, let's get to it. So based on our unadjusted trial balance, we know we had a service revenue of $74,500. We report our expenses, followed by a list of all our expenses for the period. We had salaries expense of $16,400, depreciation expense for the equipment of $2,500, depreciation expense for the building of $1,800, supplies expense of $1,100, insurance expense of $1,100 as well, and interest expense of $2,200. That will give us a total amount of expenses of $25,100. And since our revenues exceeded our total expenses gain, we have a net income of $49,400. We're going to check the answer. Fantastic. Moving on. And so for our statement of retained earnings, we're going to start with our beginning retained earning balance that came from the trial balance. We're going to add the net income of $49,400 that came from our newly calculated income statement. Then we're going to subtract the dividends of $2,200, which will give us a retained earnings ending balance of $68,200. We're going to take that $68,200 and transpose that to our balance sheet. We're going to check the answer. Well done. Now we're going to mosey on over to our asset section of the balance sheet. Therefore, we're going to start with our current assets. We have cash of $11,800. We have accounts receivable of $46,000, followed by office supplies of $29,500 and prepaid insurance of $6,300. We summarize a total current assets of $93,600. Then we move into our long-term assets. The group of long-term assets we have are property, plant, and equipment. Therefore, we're going to report our building at cost of $63,000, and directly under that gain, we're going to subtract our accumulated depreciation balance of $25,000. Remember, our plant assets are always reported on the balance sheet at its book value, which means the cost of the asset minus accumulated depreciation. Therefore, we have a book value for this particular building of $38,000. We do the same for equipment as well, given a book value of $20,300, and we summarize our total PP&E accounts to be $58,300. Once we add our long-term assets to our current assets, that gives us a total asset amount of $151,900. We're going to check our answer. Now we're going to complete our liability and stockholders' equity section of the balance sheet, starting with our liabilities. Remember, our liabilities have to be broken down into current versus non-current long-term liabilities. So we're going to start with our current liabilities. We have accounts payable of $32,100, followed by interest payable of $2,200. Next, salaries payable of $2,600 and unearned revenue of $21,000. That gives us a total current liabilities of $39,000. We're going to mosey on over into our long-term liabilities. We only have one that we have to report, which is the notes payable for $32,700. Once we add our current liabilities to our long-term liabilities, that'll give us a total liability of $71,700. Next, we mosey on over to the stockholders' equity section. Remember, our first part of stockholders' equity will always be common stock. We have some common stock of $12,000. And then we have to report our ending balance retained earnings, which comes from our statement for retained earnings that we previously calculated of $68,200. We add our common stock up to our retained earnings, and that'll give us a total stockholders' equity of $80,200. Lastly, we need to add up our total liabilities and stockholders' equity, which will give us an amount of $151,900. We're going to check that answer. Well done, gang. Now that we completed the financial statements, we're going to close out those temporary accounts, starting with our revenues. Therefore, we're going to debit service revenue for $74,500 and credit income summary. Check the answer. Fantastic. Moving on. Next, we're going to close out each one of those individual expenses into income summary by debiting income summary for $25,100 and closing each individual expense account out with a credit. We're going to check the answer. Fantastic. Next, we're going to transfer that net income from the income statement of $49,400 into retained earnings directly by crediting retained earnings and debiting income summary. We're going to check the answer. Fantastic. Lastly, we're going to close our dividends account into retained earnings by debiting retained earnings for $2,200 and crediting dividends. We're going to check that answer. Beautiful. And now the final boss.
Do it! Just do it!
Now it's time for us to calculate the current ratio and do some preliminary financial statement analysis. We're going to use the current ratio to measure the company's ability to pay off its current debt with its current assets. We know the formula for our total current ratio is total current assets divided by total current liabilities. Therefore, based upon our balance sheet, our total current assets was $93,600 and our total current liabilities was $39,000 gang. That will give us a current ratio of 2.4, which basically means that for every $1 the company has in current debt, they own $2.40 of current assets. We also could consider that the company can pay off its current debt based upon its current assets 2.4 times. We're going to check the answer. Nice work, gang. So there you have it, gang. A very detailed problem that consists of creating financial statements, closing journal entries, and evaluating the company's current ratio. It's a lot to process, I know, but you are now one step closer to chasing the bag with this financial accounting information. If that light bulb clicked, which I know it did, smash that like button, smash that subscribe button, and share the channel with your friends so they can get it too. As always, gang, I'm Dr. Who, and it's my humble pleasure to have you guys share your time with me, and I'll see you soon. Thanks!